Well, greetings and thanks for joining us for another episode of Lightbulb Moments. This is episode number 200 something. I don't know what it is. Maybe JP knows. She could put it in the chat. But anyway, thanks for joining us today. Whether you are joining us live, which is most Wednesdays at 10 a.m. Central Time, or whether you're listening to the podcast or viewing this on YouTube, we're glad you're with us today. Lightbulb Moments is a forum that really we hope to create maybe a spark. Remember, you can't start a fire without a spark. And so in this forum, we hope you get ideas that you can turn into action. Remember, your spark can become a flame and change everything. So thanks for sending your precious attention and time with us. No money required. I always reference that because we have three currencies in life: attention, time, and money. And we're very thankful that you decided to spend it with us today. We do have a couple of sponsors I want to give a shout out to. Lightheart Sanders, the CPA firm that's really a legacy sponsor. They've been sponsoring for many years, so thanks to them, as well as Zenoti. So here we are in December. I'm stamping a time here. And it's a very wintry, snowy, white day here in the great state of Minnesota with a ton of snowfall. And we're definitely getting into the holiday spirit here in the great north. Wherever you're dialing in with, we'll stay away from weather-related conversations, but we do want to start thinking ahead about next year. Last week's episode was with Candace Gliato, and we went through some great planning tools and how Candace kicks off her planning, which is super powerful and unique. So definitely listen to last week's session. Today, we're going to get technical. This is going to be a little bit more of a zoom in session on a topic, one of my favorite topics, which is taxation, especially given I spent probably about the first 15 years of my career working in the area of taxation. And I always love this quote by a French person back in the 1600s, I believe, that still applies today. The art of taxation consists of plucking the goose to get the most feathers with the least amount of hissing. Isn't that about right? So today we are going to invite a subject matter expert, Chris Wittich, who is a CPA with the firm Boyum. And I'm going to have Chris in a moment spell out the rest of the name of his firm. But Chris has been a guest in the past on Lightbulb Moments, and he does have a specialty within salons, and he also loves tigers. So, Chris, good morning. How are you today?
Absolutely. It's good. I got my snow removed from my driveway, but that is the last mention of snow.
All
I
right.
promise.
Well, you are, why don't you say the name of your firm?
Boyum and Barenscheer. Um,
Berenger. Okay.
yeah,
My apologies to Berenger, by the way. So,
it's all right.
now you reached out to me a couple weeks ago and said, "Hey, want to make sure that your clients and your listeners are brought up to speed on the whole tax law changes, specifically as it relates to tips, and specifically how it relates to employers and employees."
Mhm.
So we spent some time prepping for this, and I think we should just dive in on this and really create sort of a practical session. And I think some people will be listening to the recording here. So now there's some interesting things going on with the new legislation as it relates to tips and taxes. And part of some of the complexity and part of the maybe reason we need to put a little extra attention into it is that the W-2s were already pretty much done for 2025. So when it comes to the 2025 W-2 season, there's going to be a little bit of massaging that needs to be done. And then in 2026, it'll be more clear on the W-2s. So anyway, let's take it away and let's frame this discussion into, you could do an overview if you want, and then let's frame it into two different buckets if we could. One would be how it relates to employers,
Yeah.
And the other one would be how it relates to individuals working in an employee-based salon. And then take it away.
Yeah, so just the big picture overview, there are sort of these two buckets. One thing is the tip credit, and the tip credit is for the owner of the business. The employees don't know if you're claiming the tip credit. They don't know how much it is. It makes no difference at all to the employees. And then conversely, this no tax on tips that they like to call it politically, or a tip deduction, that is at the employee level, and it kind of has nothing to do with the salon owner, except, to your point, these W-2s, they passed the bill in July. IRS works very slowly in terms of updating forms and guidance. And so by the time this guidance was available, it was too late to be updating or changing these W-2s. And so there is going to be a little bit of impact on the employer, even if it is not a direct, tax impact. It is not going to change the tax situation for the owner, the fact that your employees are getting a tip, but it's going to be a good opportunity for the owners to provide a little service to the employees. I think take a little credit almost for the fact that they're getting this deduction. And, you want your employees to benefit from the tax law change, even if it doesn't directly impact you. Happy employees is always a good thing. That's always what we're shooting for. So that's kind of how I see it is the tip credit is just for the owners. The employees don't know anything about it, doesn't matter to them. And then vice versa, the tip deduction, the no tax on tips, is the flip side of that, where it matters to the employees. The employer is going to need to help them out a little bit this year, but otherwise it doesn't change the tax for the owner.
Let's come back to specifically how the employer is going to help the employee in a moment. Okay. But I
Okay.
do want to set the stage for this conversation. We're under no illusion that every single company in the professional beauty industry is in full compliance.
Yep. Yep.
I'm mindful that some of our listeners, hopefully most of our listeners are in full compliance, but this is not a place to really create judgment or whatever. So I do think that as we go through this conversation, we should distinguish between those that are in full compliance, which essentially means the employees are reporting their tips to the employer. The employer is withholding and paying payroll taxes, and everything's squeaky clean. All right. So, anything on that before we get to how employers can help employees?
No, I mean, I've had a lot of questions from our clients that maybe we're not quite in full compliance, they're partial compliance. And I would say there's no time like the present to increase your level of compliance. Increasing your compliance today does not raise a red flag. I think if anything, maintaining a low level of compliance is more likely to cause a red flag, because I think we're going to see a step up in compliance sort of across the industry, because a lot of the barriers to compliance have been removed. So the more compliance, the better. And we'll leave it at that.
Okay, we might come back to that, but let's go through specifically. And you had some very tangible ways that an employer can be of service to their employees
Hmm.
and more or less cut an issue off at the pass, if you
Yeah.
will. So let's go there next.
So as you were talking about these 2025 W-2s, they're going to be issued here in January. As of the recording, it's December 10th. Um, there has been guidance in the past couple of weeks and then in the past couple of months. And so what the IRS is saying is that there is no changes at all to the 2025 W-2s. But the IRS recommends that employers provide the information to employees, even though they have absolutely no requirement to do so. That is also my recommendation. It was, before the IRS came around and said that. And so, what is it that the employees need? They really need two pieces of information. And the first piece of information is the qualified tip amount. and the second is an industry code. So what's going to happen is that those two pieces of information are not on their W-2s. And inevitably, your employees, they're going to go, in February, they're going to go to prepare their tax return, right? And they're going to use TurboTax or they're going to use some online thing, some accountant maybe, that's going to ask them, hey, do you have tips? And they're going to say, yes, I do. And then it's going to ask them, what is your qualified tip amount? And they're going to sort of shrug their shoulders and be like, I don't know. And they're going to ask you, the salon owner. The second question is going to ask them is, what is your industry code? And again, that is supposed to be, and it will be in the future, assigned by the employer. And so they're going to say, well, I don't know what my code is. And they're going to ask you, the employer. And so what we want to do is provide those two pieces of information directly to the employees in conjunction with as like a supplemental statement to their W-2. And this is not going to be super hard to do, but I think it will save you a big headache. It will save your employees the hassle of like they sit down on some Tuesday night, they think they're going to finish their tax return, and then they're like, wait, I don't have this information. And they're going to initially think, why didn't you give me this? They're not going to realize it wasn't, your responsibility. So it's those two pieces of information, the qualified tip amount in a salon is going to be equal to the amount in box 7 on their W-2s. In some other professions, there are some nuances that can come into play, but that shouldn't apply to the salon industry. It should be very straightforward that the amount in box 7 is the same as your qualified tip income. It's not labeled as that on the W-2, so the employee is not going to know. But for you, it's really just taking that number and repeating it to them, but giving it a different label and telling them, hey, this is your qualified tip income. The second piece of information, even easier, it is what is the industry code? And so the IRS has published a list of these. The 100 range, that's for restaurants and like food industry stuff. So if you keep looking at the list, you will find that the 600s is where they have personal services and in particular code 603. There is all three-digit code. So code 603 is the code for hairstylists, barbers, cutting hair, all of these sort of similar things. So I think most of the people in a salon are going to be code 603. There was a different one for shampoo or for nails or for, med spa stuff, but it'll all be in the 600 range. So most of these stylists, they're going to be code 603. And so really the two pieces of information which they need, they're pretty easy. It's the amount in box 7. You just need to tell them it's qualified tip income. And then you need to tell them their code is code 603. And
Yeah.
from there, they will have everything they need to do their 1040s. So the advice is to give them that on a supplemental statement in January when they get their W-2s.
Okay. Super clear, super simple, and a super proactive step that could prevent all sorts of other things that come in. So thanks for that. And I hope
Mhm.
that our listeners really take that to heart in terms of how that could be of service to their employees and also prevent a lot of like Q&A back and forth that
Yeah.
could be disruptive. So thank you for that. Let's move on then and unpack a little bit about each of the different tax opportunities here.
Mhm.
With certainly, I think the simpler of the two is the tax credit for the
It
employer.
is. It is
So,
very simple to calculate. The concept is that when tips are paid to your employees, the business is paying FICA tax on that, which doesn't really seem fair. You didn't give the employees this tip, but you are incurring a cost. And so what the tip credit does is gives you a credit for that full amount. So how you calculate it, actually incredibly simple. You take sort of that box seven, those tips that are getting reported through your wages to all these employees, and you multiply it by 7.65%. That is the amount of the tip credit. Like you're done. The math is easy. You know, if you've got $100,000 of tips, your tip credit is going to be $7,650. I could tell you that right now. Beyond that, how does it work? There's a little bit to it, but it's really fairly simple. You're getting a dollar for dollar tax credit. So most salons are set up as a flow-through entity, probably an S corp, sometimes a partnership, so that tax credit flows through, and then it is the individuals that would claim that credit of, the $7,650. The nuance to that is that the individual taxpayer needs to have a tax liability. And if you don't, you won't get a benefit from the credit. Instead, you will carry it back and then forward. So you can use it some year, but it's not refundable. So it's based on the income of the individual. That could be either your wages, or the flow through income from the salon. Your credit can offset those. So if you have a large salon, $100,000 of tips, that's, your $7,000 tax credit. If you have $1 million of tips, that's a $70,000 tax credit. So it can be very substantial. It scales to infinity. There's no maximum, so to speak. The maximum or the limit comes into play at the individual level. You have to have a tax liability. And sometimes when you are maybe doing a build out in your salon, you might have a year where there's a big loss from this build out, and you're like, hey, my tax for the year was $0.0. You are not going to benefit from the tip credit, but you can carry it back and then carry it forward and use it in a different year to get that benefit. So the math, super easy, and it's kind of putting you on a fair footing. The restaurant industry's had this for, 30 years. Now it's available to the beauty.
Yeah. And, there's been a lot of recent celebration, which is very much justified
Hmm.
for the team effort that went into it in the industry to make this happen, which only took about 30 years. So shout out to several that have been involved in this. Certainly the Professional Beauty Association. Certainly there's select individuals that's been acknowledged and celebrated, and we celebrate them too. This is really a big benefit. Now, I was on with someone. I think it was yesterday, and I thought the number they quoted was like $800,000 in tips. Um,
Hmm.
and so based upon your math there, I mean, help me with the math. I mean, that could wipe out their
For sure.
entire tax liability.
Yeah, I mean 50 grand, 55 grand is your tip credit on $800,000 of tips. So that's that's one of the benefits of this tip credit is that there's not like a maximum. There's no such thing as too big.
Yeah,
There are on a lot of other tax breaks, there's income limits and stuff like that. There's no income limit.
yeah.
The income limit is sort of in reverse. You need to have income in order to benefit from it. But yeah, it's scalable to
Let's go.
infinity.
Let's stay with employers a little bit longer than we're going to go over to employees. You just dropped this whole idea. So let's say that someone has a 25,000. Well, I'm not going to pick that number because it'll compete with another 25,000 later. So let's say that there's a $20,000 opportunity for a salon,
Hmm.
but they have no taxes this year because they broke even.
Yeah.
You kind of threw out carry back and carry forward.
Hmm.
A carry back would mean they could get real money back.
Yes.
So
Yeah.
let's play that out. So Salon has $20,000 of profit, and they have a $20,000 credit. So now they have zero taxable income. Okay,
Hmm. Mhm.
Actually, that's a bad example because we want to carry back. All right.
Well, yeah, so it's really at the individual level. If you had, zero income, or, there are other credits people have, you have other deductions, you know, you gave a ton to charity, whatever it is. If your income, was low enough that you got your tax liability to zero and you have this $20,000 tip credit this year, the way it works is it goes back 1 year. So you can look back at, did you have tax liability in 2024? And if the answer is yes, there's a special form you file. The IRS says they will process it quickly. I don't believe they'll process it super quickly, but in theory, in 3 to 6 months, you can get an actual cash refund. You might have had a tax liability of 50 grand last year. So you take this 20, which you couldn't use any of it this year, you carry it back, you will get a $20,000 refund sent
Yeah.
to you, cash refund sent to you from the IRS. If last year you also had zero tax liability, the way it works is it goes back 1 year and then it goes forward for 20 years. It's a little convoluted what happens if you haven't used it in 20 years. I'll spare
Yep.
you that, but you can use it next year so that
Okay.
when you do have income next year, you'll have the carry forward plus whatever the current year tip credit is.
Perfect. Okay. Let's move over to employees for a moment.
Hmm.
And let's unpack that just as a, do like a zoom out on a little bit, and then we'll
Yeah.
zoom in with details.
So the no tax on tips, super useful. It is up to $25,000 of tips. So if there's a stylist that has 30,000 of tips, they're limited to only 25,000. These tips have got to be on their W-2s, but we're in compliance. We're putting them on their W-2s. And so it happens when the individual files their individual tax return. That is when they get this deduction. So it is going to cause a lot of them to have refunds that are probably higher than they've had in the past because they're going to get this brand new deduction. It might be 15, 20, 25 grand, depending on how many tips they have. And so they will sort of reap that benefit when they file. There is an income limit, but the income limit is relatively high. So for a single person, the income limit is 150,000, and that phases out over time. So if you had a stylist with 151,000 of income, they don't lose all of this tip deduction. They lose just a little bit of it. So instead of 25,000, they can use $24,900. It's not the end of the world if they clip over that income limit. And for joint, it's higher. The odd thing with this is that the $25,000 tip limit applies whether you are single or joint. If both are married and they're both like stylists or getting tips in other industries, you still only get the 25,000, which is a little odd. But um,
That's interesting. Okay. Let's talk about the situation where the owner is also behind the chair and the owner
yeah.
is getting tips.
So the owners can absolutely also receive this tip deduction. I think the owners are going to have perhaps more of an issue with the income limit than some of the individual stylists. How many single stylists do you have in your salon that make more than 150,000? There can absolutely be some, but the majority of them are going to make less than 150,000. The owner themselves, they might be getting some salary, but then some commission and tips. They might be getting entirely commission and tips for just behind the chair. They can get the tip deduction. And so that's a key point where in the past, if you owned 100% of the salon, it's possible you were not capturing your tips into your wages because you had no real reason to. It didn't make any difference. It makes a very big difference now. If you are behind the chair and you are an owner, you have to be absolutely certain that those tips are going into your wages as tips and not as just regular earnings. It didn't matter before, didn't mean you were doing it wrong for yourself before, but now you need to get it as tips so that you can also benefit from that tip deduction.
So I've been curious about something, and I haven't verbalized this. So I'm going to try to verbalize it for the first time, but it's been in the back of my mind ever since this whole thing, no tip, no
Hmm.
taxes on tips. It really creates an incentive to shift some of the income that's received by a client um, to hire more tips. So in a perfect world, now I don't know how you operationalize this. You probably don't. Isn't it better to maybe charge a client less money for the service and take a higher tip because of this?
So the key with the tips is that they have to be voluntary.
Hmm.
So you need the client to actually tip you more. If the client's going to tip you 20% and you charge them less and they just tip you less, like that's a disaster.
Mm-hmm.
You would need them to actually tip you more. But in that scenario, like, yeah, receiving, 30-40% tips would be a little bit better. But there's also this cap at 25,000.
I get
And so
it.
I think you're gonna have stylists, especially at a good salon where if they're working, you know, pretty full time, 30 hours a week kind of thing, a lot of them can get to the 25,000. So there's really no advantage or reason to go over that. So that's sort of the limitation there.
Sure.
But
Yep.
yeah.
Gotcha. Now, um, so in the case of the stylist, it's not the individual employee.
Hmm.
Um, it's there's other components to this, if you will. Like, for example, doesn't the employee still have to pay payroll taxes at
They
their
do.
level? Okay.
They do.
Okay.
I
That
think
that's sort of in the fine print. A lot of that doesn't kind of pop out to people, but
it
let's go
is.
there for a moment.
So when there are tips, they're being captured, the employee is paying income tax on it, and they are paying FICA. And then the employer was paying FICA. So now we have a tip credit that makes the employer FICA go away. And we have this tip deduction, which helps the employees with their income taxes, but they're still paying the FICA. I think a lot of employees maybe don't realize they're paying the FICA. And so I think this is one of the reasons why sort of the voluntary tip compliance, when you ask them about your cash tips, they had an income tax and payroll tax reason to potentially lie to you. And now they don't have that income tax reason to lie to you because they won't pay tax on the income taxes. Um, and a lot of them just don't even understand that there is the FICA on it. So I think we'll see the sort of the voluntary compliance go up because it is tax free, but they don't understand that they're paying into FICA. They will get credit for that in their Social Security. So, there is a cost to it. They're paying their 7.65%, but it gets them, a higher Social Security benefit down the road when they
Yeah.
retire.
All right. Well, so in terms of, listen, I've always been a big fan of tax compliance and all of our money, what we teach students, what we teach solos, we lean in pretty heavily on the importance of tax compliance, distinguishing between tax avoidance and tax evasion, which the difference between the two is legality. One's legal, one's not.
It's very important.
And now, from a compliance standpoint, there are some things unrelated to Social Security benefits why a stylist would really want to start to, and we've been preaching this for decades, but
Oh, for
let,
sure.
let's use a very tangible example. And I actually found this in some of your literature here. So let's say you got a $50,000 W-2
Hmm.
because you're not including tips.
Yeah.
You might qualify for a home of, say, 200,000. This is your example, by the way. Thank you
Yeah.
for that. However, if you report all your income, so instead of being 50,000, it's 75. Now someone could qualify, for example, a $300,000 home.
Hmm.
Is that a fair way to look at it?
Yeah, I mean that individual employee, they can qualify for more credit either for cars or houses, or if what they wanted was the $200,000 house anyways, they can get better rates. You can get a better rate on the same thing because you're much more able to afford it. And so the bank sees that, hey, they actually make 75 grand. They can afford this. And so they can save a lot in interest, in fees, like mortgage insurance, stuff like that, where if they had just told the truth in the first place, they would have qualified for all of this stuff a lot easier and it could have been cheaper. And now because there's this income tax deduction, they're not even going to be paying income tax on it at the federal level. Um, States can be different, but I think it's going to increase the compliance on that individual level because they've removed some of the barriers.
Yeah, so you've summarized it here, reporting your tips, no extra tax and more financial power. It's not just about tips. I'm sorry, it's not just about taxes. It's about getting approved for loans,
Yeah.
buying a dream home or something else that is important to you, building retirement benefits, and sleeping well at night.
That's the cherry on top, is
Okay.
knowing you're actually in compliance with the rules.
Okay. All right. Um, Listen, I think you've hopefully made this very clear to our listeners and that our listeners have found this to be a valuable 30 minutes to this point so far. But I want to go a little further with you and then, bring up something else that we were going to see if we had
Sure.
time for. And let's go to the whole overtime piece. So we're moving
Mm,
away from tips and we're moving over to something else that also has sort of that W-2 element and a
it
bridge
does.
here. So let's talk about the no tax on overtime briefly before we wrap up.
Yeah, so the no tax on overtime, a lot of it works very similar to the tips. There's a $12,500 deduction, but then a married couple, both of them could get it. And again, this is not going to show up on their 2025 W-2s, but it will in the future. So the suggestion is that the employers provide supplemental information that tells people how much is your qualified overtime pay. And so the definition of the qualified overtime pay is based on the FSLA, or is it FLSA? It's one of the two. Fair Labor Standards Act, FLSA. So it's based on those definitions of overtime. And so it's really the time and a half. So this is going to be for hourly employees. If you have commission-based stylists, they're not getting paid overtime, but it's the hourly employees that are. So if they're getting paid, $20 an hour, and one week, they got some extra shifts and they worked 45 hours, they got 5 hours of overtime pay, and you're paying them time and a half. It's the half that's the qualified overtime. So in that example, they have 5 hours of overtime. Their base pay was 20, the extra half was 10. So 5 hours times the 10, they have $50 of qualified overtime pay. This one might be a skosh harder to look up in your system, but again, you're not going to have a ton of people with this. So I think you're going to really do them a solid if you look this up, because otherwise employees are not going to be able to figure this out themselves. They're going to be
Yeah.
left with like trying to look at their own pay stubs and sort through this. And every, payroll system kicks out pay stubs a little bit differently. So I think you want to tell any employees that have overtime, like in our accounting firm, we are going to do this in January. We have admin staff that get paid hourly, they get overtime during tax season. We are going to tell them, hey, this is the amount of qualified overtime pay that you have. So that's for any industry. That's not industry specific, but salons could definitely have a couple of people that fall in that same, bucket of a little bit of overtime.
Perfect. Good stuff, Chris. All right.
Mhm.
Before we wrap up, what's with you and the Tigers? In your other office,
I
there's even
love
more
tigers.
tigers. What is with you
I
and the
know.
tigers?
It dates back to high school. It was a nickname. Ravenous Tiger was my nickname in 10th grade. Came from a biology class and a friend, and
Ravenous tiger?
Ravenous Tiger. And now people tend to call me the Tax Tiger. I wasn't doing taxes in 10th grade, but I
All
spend a
right.
lot of time doing them now. So,
All right. Tell us a little bit more about you other than shoveling the driveway this morning. You live in Minnesota. Just you got a
um,
couple kids and all that.
yep. Couple young kids are 1 and almost about 3.5 or so. Um, and been here at Boyum for like 20 years, give or take. Um, but love working with the salon industry. I think the name of the firm can be a little confusing sometimes. Uh, salon.cpa is the easiest way to track us down,
All right.
to remember it.
Well, let's give Chris a virtual round of applause. Thank you. Thanks for getting technical with us today. I think there's a question in the chat. Maybe you want to just address that on your own in the chat. And Chris, you
Oh,
should have
sure.
had one of these in the past. Did you $1 million light bulb?
I
Uh,
don't think so.
well, if you were a guest in the past, you should have gotten one. Maybe you weren't a guest, but anyway, you'll get your $1 million light bulb, and that makes you officially a member of the Brain Trust.
Thank you.
And it also means we'll extend an invitation to you at a celebration of light bulb moments in May at the annual Phil conference. So thanks for this information. I think you explained it really well. And I like how you led off by really stressing this is how you can really prevent an issue with employees and also be proactive with a couple of simple steps, which, most of the organizations that we work with want to be an employer of choice. And I think that's part of being an employer of choice. So, Chris, thanks again. The rest of you, we are on next week. We've got just a few more. What are we? 3 weeks to the end of the year? Is that
Yeah,
right? 3 weeks
yeah.
exactly, right? New Year's is 3 weeks from today. All right. Well, this is a great time to end strong. It's also a good time to do some planning. And don't forget to do your tax planning. So, and thanks for all of you for joining us today. And we will see you all very soon. Thanks again, everybody. Take care.